Mr. Bove joins us now from Tampa with more on his assessment of those banks and the industry. Mr. Bove, always good to see you. Thanks so much for joining us today.
Well, thank you.
And talk to us about that assessment today of Citigroup. What's going on?
Well, I think that, Citigroup had to pay a pretty sizable penalty when they paid back the government funds. I think it adds up close to $6 billion after tax, well over $8 billion pre-tax, and that hit is going to be taken in the fourth quarter, which means that fourth quarter earnings will probably be a little bit worse than we thought.
How much worse?
Well, I had assumed that the company would lose 27 cents in the fourth quarter. Now I am assuming that they'll lose 32 cents in the fourth quarter. I actually don't think that difference means too much. I think that it's merely trying to fine-tune what the estimate is. And I think much more important, analysts are not going to be looking at what these banks earn in the fourth quarter. What they're going to be looking at is something called their early-stage delinquencies, which is, are the loan loss problems getting worse, or are they starting to be alleviated somewhat? If they're getting worse, the stocks will do poorly. If they're being alleviated somewhat, which is what I expect, the stocks will pick up.
So, Dick, I assume you think that they're being alleviated somewhat as the economy does start to make some tentative steps towards recovery?
That's exactly right. In other words, it's pretty hard to assume that we're going to get more, residential real estate losses than we've gotten for the last couple of years. It does appear that the situation with commercial and industrial firms and even with commercial real estate may not be as bad as people expect. And of course, the consumer, I think, will be flatlining in the sense that the losses will be high, but they won't get higher. And that's the critical issue, because what people are waiting for is, when are we going to see the turn in bank earnings? And to determine whether that turn is ahead of us or not, what they're looking at, as I say, is this thing called early stage delinquencies.
Dick, what happens when the government does withdraw more of its stimulus? Obviously, we're starting to see a wind down of that. But do you think that there is the possibility that we could see a second wave, a second dip in things like delinquencies, in loan losses, for example?
Well, it's always possible. I think the factor that the government is if you'll accept this, the total support of the mortgage market at the present time. When the government steps away from the mortgage market, it's going to create an increase in losses. And I think that, clearly there are going to be problems still in commercial real estate. But I actually think that inventory building should lead to increased capital spending, should lead to more job creation, which should lead to more consumption. And therefore, I don't think we're going to get a double dip. I think we're going to come out of this.
But Dick, when do we actually start to see some of those tentative steps? Right now, as you know, the unemployment rate's still at 10%, and as you mentioned, commercial real estate, it might have a heartbeat, but we're still seeing some problems there as well.
Yeah, I think the thing that's going to be very upsetting to everybody is the fact that we're going to have an extraordinarily high unemployment rate for the next 5 years. In other words, if you take a look at what full employment is believed to be, which is 4% unemployment, that would require us to create 250,000 jobs every month for the next 5 years.
And you don't see that happening, do you?
No, it's not going to happen, which means that the unemployment rate is going to stay in that 7 to 10% range for at least the next 3 to 4 years. And that's bad. That's not good for the economy.
Well, how then are the banks going to be able to continue to grow the earnings?
Well, basically because the whole issue with banks right now is getting rid of loan losses. In the first 3 quarters this year, in each one of the quarters, the banks wrote off $60 to $65 billion in loan losses, and their profits were $0 to $5 billion. So if you add those two numbers together, basically every quarter the banks pre-tax, pre-provision earned $65 billion. At the present time, all of that money is going to loan loss provision. As we go into the next couple of years, that money will all go to pre-tax. So you'll have a couple of years from now $45 billion in pre-tax per quarter and $20 billion in loan loss provision. Obviously, you've got to get some improvement in the economy for that to happen, but I feel strongly that it will happen, which is why bank stocks look pretty good.
Well, Dick, I guess then the question is, what's the reaction going to be on the part of the public? We're already starting to see this, and we're going to take a break in a few seconds. So just wanted to get your quick initial thoughts on all this bonus controversy. You know, Andrew Cuomo, the latest to ask for details on bonuses from many of the banks.
Well, Cuomo is anti-New York. I mean, I think the bottom line is that, you know, people are going to be furious. They don't want people in Wall Street to make this much money. And quite frankly, as investors, who cares one way or the other? I would rather see the money go into dividend payment than bonuses. But, you know, that's a board of director decision.
Dick Bove of Rochdale Securities joining us today. Always good to have you on the air, sir. Thank you so much.